And now we're live. And then we're going to put together this cash flow statement. So then I'll give you the video. I'll put it up somewhere and you can have it, yeah? So cash flow statement, kind of like all other financial statements, you start off with a company name. So I got this company, Galley Corporation, and we'll call it Statement of Cash Flow. And it's dated like an income statement, okay? For year ended December 31st, 2011. And then you can make it look nice if you want to. If you were preparing it in a formal situation, maybe for a client or for the company you work for, then you probably want to make it look nice. Over here on the right, I'm going to have some of my notes. So it's really not what goes into the cash flow statement, but I'm going to be doing some calculations over here. So I'll leave some space. But this is about where we're going to put it. And I'll make it a little smaller. So we always start with the operating section. Okay. So we'll call it operating activities. Okay. And in that operating section, we start with our net income. Okay. So where am I going to find net income? Exactly. So I'll come looking around here, snooping around, balance sheet, income statement, and my net income is at the bottom. Remember, that's accrual-based net income. So 201,000 is going to be what I start with. Okay. Then I'm going to have this header. I call it a header. It's called adjustments to reconcile net income to cash flow from operating activities. I've done it so many times that I think I remember the verbiage in there fairly accurately. Okay. And I kind of center it in there, and then that's when we start listing our reconciling items. Okay. So you guys memorized, yeah? What was the first thing we're looking around for?
Depreciation expense.
Okay. So we're going to add back depreciation expense. You could make two categories. You could make a category for add back and a category for subtract, but I'm just going to put them all together in this example. Okay. Where am I going to find depreciation expense? Exactly. Okay. So we can go look around. It says right here, 54,000 depreciation expense. Okay. Now, we want to look for any gain or loss on the sale of equipment. Okay. So the first thing I would do is I would come over here and look at my equipment account, and then I would also look at the additional information here. So it looks like we just purchased equipment, right? $297, and it went up to $333, and we bought $36,000 worth of equipment. So $297 plus 36 looks like it is $333, yeah? What's 297 plus 36? We'll do it right here. Okay. So I kind of explained the change in the equipment account. There's another way we can do it with T accounts and get more analytical about it. But for now, it looks like we only bought equipment. We didn't sell anything. So it's more likely than not we're not going to have any gains or losses. Okay. So back to the rule, right? If you have it, you need to reconcile it. If it's not there, then pass. Now what do we do next? We've got to figure out the changes, right? So we need to know the change in our current assets. So we got two current assets, we got accounts receivable and inventory, and then we got two current liabilities. We got accounts payable and taxes payable, right? So let's see. Accounts receivable went from 81 to 93. Okay. So there's an increase of 12,000 in accounts receivable. Okay. What did I say what the rule was, right? We're going to subtract increases in current assets, right? So I'm going to subtract that $12,000. This here on the right is just my notes. That wouldn't be part of the, on the left, I mean. That wouldn't be part of the actual statement, okay? Now inventory went from 534 to 609, okay? So that's also an increase. And I'll subtract that guy. Accounts payable decreased. Okay. So it went from 96 to 69. Now the rule is opposite, right? Decreases in current liabilities are subtracted. So that 27 is going to be subtracted. We'll say decrease in accounts payable. What did taxes do? Taxes increased by 3,000. Taxes payable, right? So again, opposite, any increases, yeah, are going to get added back. So you got your reconciling items, right? What you do is you run a subtotal. So I kind of put a line there at the bottom, and then I'm running a subtotal. I'm totaling up all of those reconciling items, and I get a net 57,000 negative. Why don't we do it like this? Make it look more financial, yeah? Okay. So if I take the 57,000 and subtract it from my net income, we're going to call that the net cash provided by operating activities. Okay? If it had been negative, if this number is negative, you would say net cash used in operating activities. But in this case, it's positive. Your operating activities provided you a positive cash flow. Okay? You guys got it? Okay, good. Now, remember, these are just notes over here. This stuff in yellow. That's not really part of the statement. The next section is going to be my investing activities. Okay? For investing activities, we want to look over here at long-term assets. And we really only have one long-term asset. And they actually tell us what happened, so we don't really have to go compute the difference. It says we purchased equipment for $36,000. What do you think that's going to be? The purchase of equipment, is that going to be positive or negative? I think we're thinking in terms of cash flow, right?
Pushed out cash for equipment.
Right.
Oh, so it would be negative.
Yeah, it's cash flowing out, right?
Yeah.
So whenever you look at one of these things, you want to think, okay, is it cash coming in or going out? So if we bought the equipment, yeah, so that's going to be a negative. And that's the only one that I see. So you know how we are, we kind of get redundant and we end up doing something like that. So I would probably kind of set it up like that, and then I would say net cash used in investing activities. That's the only one that I see, right? But you want to look really good, right? And the neat thing with this problem is we have the check figure already. The check figure is this change in cash. So you might want to put that up here too. Your cash on your balance sheet, it went up from 117 to 174. So this is what we're trying to, that's what we're trying to prove. We're trying to prove this 57,000. Okay? I'll put
Increase, right, in cash.
the increase in cash. Okay. So when I get down to the bottom of this, we're going to know whether we're right or wrong, whether we've considered everything or not. Because it's going to need to balance with that 57,000. That's how we tie the balance sheet to the cash flow statement. Okay. So now, financing activities. Okay. Financing activities involve any long-term liabilities. So I'm looking here and we don't have any we don't have like notes payable or bonds payable. So there are no long-term liabilities. And then the second thing that's involved is the equity, the common stock. Okay. So let's see, common stock. There's two common stock accounts. There's a common stock account and there's the additional paid in excess account. Okay. Both of these increased, right? So if we sold more stock, oops, is that, I left a V out of this thing, right? What's going on? I guess that's right. Okay. If we sold more stock, is that cash coming in or going out? Think of the journal, the first journal entry you learned in 201. When you issue common stock, what do we debit? And what do we credit? Very first day when, remember the problem, Sally opened the sporting goods store and
You guys from last semester, you go a year ago.
sold 10,000 shares of stock. So she issued $10,000 worth of stock, and so there's a debit. So think about it this way.
Increase the cash then.
It is, because the journal entry is like this, right? When you issue common stock, you debit cash and you credit common stock. Now in this case, we have another account, but it's part of that transaction. It's called additional paid, they call it additional
Paid in capital.
paid in capital. I'm just going to just say additional paid in. That's that second account. Okay, so common stock went up by, it went to 582 from 558. You see how I got that difference? Just over here on the balance sheet. Okay. And then the additional paid in capital went from to 36,000.
Yeah, it's to 160, yeah, 162
Yeah.
to 198.
Okay. So what that means is we sold the stock for more than its par value. Okay. If the stock's par value is can't line this up. Kind of particular about that. Anyway, it doesn't really matter. It's both indented. In this case, they got $2 par value stock, right? So how many shares did they issue? They said they issued 12,000 shares. So they got $2 par times 12,000 shares. That gives you the 24. Okay.
Was it $2?
The $2 is the par value. You see right here, common stock.
Yeah.
Okay. That's the legal value in your charter. But remember now, the stock trade, you can sell it out on the market and the price could vary, right? So in this case, they sold it for $5. Yeah, 36,000, right? So this is the what is it, 2 times, maybe I put the dollar sign in for you, yeah. $2 times 12,000 shares. And this is the,
Over, right, the $3.
because in that sentence down here, B, right, at the bottom, it says they sold the stock for $5 a share. So 2 plus 3 is $5 a share. but this is the way we record it, right? We always record the common stock at its par value, and then we have another equity account that we call additional paid in capital, where we show the excess. But they're both part of that sell of the stock. So that's the total cash, and I actually should put this over here, right? That's the total cash coming in, is the sum of the 24 and the 36. Okay, so that's what happened. But back to what I originally asked, right? This is cash coming into the company. Okay, so over here we could say, I would call it issuance of common stock, right? And you could break it apart, or you could do it all in one lump sum. Maybe we'll just do it in a lump sum. 60,000, right? Okay. Move this guy down. Okay. Okay, so we have no long-term liabilities. We've taken care of the common stock. The last thing that we got to look at is the dividend, right? Dividends go into the financing section. Now think in your head, if the company pays a dividend, is that cash going in or coming out?
It's going in.
So it's negative. Okay. So payment of dividends. And in this case, they paid item C, right? 111,000. Okay. So for now, that looks like all we have. So we can tally that guy up. Basically, the right? The net effect of those two. And then we got a negative, so this is going to be net cash used in financing activities. I left a V out of this thing, right? Okay. Okay. Now, this is where the telling point comes, because it's the sum of these, right? So the combination of the operating, the investing, and the financing, right? So we could call basically sum of A, right? Here, 144, 36, and 51. That needs to tie out. That needs to match with your change in cash. And it does, right? Remember we figured. So that's how you check yourself. If after you do one of these problems, you're not balancing down to that change in cash, then something's wrong. You got to go back and fix it. But that's a good thing about one of these problems, is you know whether you're right or wrong before you finalize and submit. Okay. Now just a few more final formatting things. We take that and we show how it ties out to the balance sheet. Okay. And what we do is we call this our, in this case it's the net increase in cash, and then we'll say cash balance on December 31st, 2010, and that would come from our balance sheet. 2010 it was 117, and this is just formatting, right? You draw a line and then you say ending cash, right? So that would be cash on December 31st, 2011. Okay, and it should tie out. So that's how you explain that change in cash. So we've basically, in a way, we've taken our accrual base net income, and we've reconciled it down to the actual change in cash. So you could kind of think of this cash flow statement in a way, maybe not exactly, but kind of being like a cash-based income statement, at least up through operating activities. So you could maybe consider your cash flow from your operating activities as your cash-based net income, okay, to some extent. Okay. So investors are interested in the way the cash flowed in the company. So we also have to have this financial statement in there, because remember, net income is accrual-based. A lot of the revenue might not have been collected yet, right? A lot of the expenses may not have been paid for yet. Okay. Or there may be things you paid for that you have not expensed yet, like prepaid rent. Okay, so those wouldn't be reflected in the net income, but they would be a decrease in cash. That would be a decrease in cash. Okay, does that make sense? It's a whole lot for the first day, but I think, wait, let's see. Shift